Does compounding truly work for everyone regardless of how much they start with? Can small investors harness its full potential? Have you ever wondered why some people seem to effortlessly grow their wealth while others struggle despite their efforts? The answer lies in a powerful financial principle: compounding. But here's the catch: it's often misunderstood. What if there's a way to optimize compounding for smaller investors? Is there a strategy that bridges the gap between starting small and achieving significant financial growth? We'll debunk this in this video. If you're eager to build a life of abundance, hit subscribe now. We're committed to sharing proven methods and insights to help you succeed. Stay till the end, because the last point reveals a controversial truth about why you may need to delay compounding to actually benefit from it. Let's get into it. Number 1. When time alone isn't enough. Everyone says, start early and compounding will make you rich. But here's the uncomfortable truth: time alone is not enough, not unless you back it with meaningful capital. Yes, compounding works best over long durations, but the real acceleration kicks in only when the amount being compounded is large enough to matter. Think about it. 10% annual growth on $1,000 gives you just $100. On $100,000, that's $10,000, without lifting a finger. The illusion of early starting often keeps people lazy, thinking small monthly investments will snowball into millions. That's a lie if you don't scale your inputs. The longer you wait to increase your capital, the longer you delay your financial freedom. If you want a $1 million portfolio through index funds, you can't just count on 40 years. You need consistent capital input. Increase capital aggressively in your 20s and 30s. Don't just start early, start big and scale consistently. Use compound-friendly instruments like index funds, ETFs, and dividend stocks inside tax-advantaged accounts like Roth IRAs and 401 KES. Compounding is multiplication. And to multiply anything, you need more than time. You need numbers worth multiplying. Number 2. Small numbers, small results. Why playing safe keeps you broke? Let's get brutally honest. Compounding doesn't reward caution, it rewards capacity. You can't invest $50 a month and expect to retire with millions. Yet, this is the fantasy most people buy into. They hear Warren Buffett say, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." And they latch on to the last part, forgetting that Buffett didn't invest pocket change. He reinvested millions. Compounding is like a race car. It only starts to fly when there's enough fuel. If you feed it teaspoons, it won't matter how long the engine runs. A 10% return on $500 gets you $50. On $50,000, that's $5,000. Same percent. Entirely different lifestyle impact. Most people treat compounding like a savings account instead of an income generation strategy. They confuse frugality with wealth building. They stay stuck in, "I'll just start small and see how it goes" mode, not realizing they're robbing their future. They buy a $6 Starbucks every day, but won't raise their investing contribution to $300 per month. Small numbers lead to small results, always. Instead of scaling up, they stay in their comfort zone. But guess what? The comfort zone doesn't pay dividends, it just preserves poverty. Focus on income growth. More cash flow is more fuel for compounding. Instead of budgeting down, earn up. Channel new income directly into high-yield ETFs, dividend stocks, and index funds. But what happens when your 10% gain barely beats inflation? That's our next hard truth. Number 3. Inflation erodes small gains. Mark, age 35, keeps $30,000 in a traditional savings account earning 1%. After 10 years, inflation reduces his real value to around $22,000. Elena, same age, invests $30,000 in an ETF portfolio, averaging 9% return. After 10 years, even after adjusting for 3% inflation, she has around $58,000 in real value. Let's say you invest $10,000 today and earn a 6% annual return. Sounds decent, right? But after 20 years, adjusted for 3% inflation, your real purchasing power is just $18,000, not the $32,000 you were expecting. Now imagine if you only invested $2,000 instead of $10,000. Your net gain would barely cover a month's rent in today's US cities. That's the hidden trap. People get excited by growth without factoring in inflation. That means your investments must grow more than 3.8% every year just to maintain purchasing power. So, if your money is compounding at 5% annually, you're only really gaining 1.2%. And if you're only investing small amounts, say $100 a month, then your actual wealth growth is barely noticeable. Aim for investment returns of 8% or more using diversified strategies. Think index funds, REITs, growth stocks, ETFs. Reduce idle cash. Move it into tax-efficient, inflation-beating investments. Use dollar-cost averaging to invest consistently, even during market dips, because over time, you ride inflation out. If your money isn't growing faster than inflation, it's not growing, it's dying slower. Number 4. The minimum threshold fallacy. We've all heard this advice. Just start with whatever you have. Even $5 is enough. While that may sound encouraging, it plants a dangerous mindset that starting small and staying small is acceptable. This is the minimum threshold fallacy, the false belief that hitting the bare minimum investment amount is good enough for long-term wealth. The problem? Compounding doesn't reward effort, it rewards scale. Let's say you invest $200 per month in a mutual fund yielding 8% annually. After 30 years, you'll have around $280,000. Not bad, right? But with taxes, inflation, and rising living costs, that might barely fund 6 years of retirement in the US. Now compare that to investing $1,000 per month. You'd walk away with over $1.4 million and a completely different life. The fallacy also tricks people into staying at the minimum forever. They never stretch, never challenge themselves to earn or invest more, and never scale beyond what's comfortable. They tell themselves, "At least I'm investing," while their portfolio grows at a snail's pace. As Tony Robbins wrote in Unshakable, the biggest risk is being too conservative in your investment approach. It can quietly destroy your financial future. That's exactly what the minimum mindset does. It feels responsible on the surface, but silently erodes your wealth potential. If you want true financial freedom, not just survival, you need to break out of minimum mode and enter momentum mode. What if the minimum you're doing today is the very reason your future is stuck? Because no one retires rich by just doing the basics. If you stay in minimum mode, you'll always live a maximum life of limitation. Number 5. Leveraged compounding, the secret weapon. Here's what no one tells you. The wealthy don't just compound money, they compound momentum. This is where leveraged compounding comes in. It's not about taking risky loans or margin trading. It's about leveraging capital, skills, systems, and scalable assets to make compounding exponential, not linear. While most people are compounding their $500 savings in a low-interest mutual fund, the wealthy are compounding rental income, dividend stocks, business equity, and high-yield ETFs, all at the same time. They aren't depending on just one stream. They're stacking multiple compounding machines, often using tax advantages and reinvestment loops to accelerate wealth. That's why someone like you can invest $10,000 and end up with $15,000 in 5 years. But a smart investor can turn the same $10K into $100K by leveraging the right vehicles. It's the same dollar, but used with 10x smarter intent. Let's simplify it. Create multiple compounding channels: dividend stocks, REITs, index funds, real estate, side business equity. Reinvest everything. Use tax shelters like Roth IRAs and SEP IRAs to protect growth from inflation and taxation. Invest in income-producing assets, not just appreciating ones. Sophia put $20K into a mix of dividend stocks, a small rental property with financing, and reinvested business profits. In the same period, she scaled to over $160K net worth, 4x faster growth with multiple cash flows. Compounding without leverage is like driving a Ferrari in first gear, full of potential, but painfully underused. You can turn small starts into big finishes, but only if you stop worshiping compounding as magic and start treating it as a powerful engine that needs proper fuel. In every video, I try to discuss and address the factors that surely improve the chances of your success. We don't just give you recycled finance tips, we give you the uncomfortable truths others avoid. If you like this also, subscribe the channel, like and share the wealthy knowledge to your loved ones. Stay smart, stay invested, and remember, it's not just about how long you invest, but how much you put on the table.